Hi, Lynn Kenyon, Everything Montana Real Estate in conjunction with Live in Montana Real Estate. And we are today talking about, like we do, all these aspects related to buying a house, selling a house in Montana, and really understanding what you're doing. These are big purchases, huge purchases sometimes, and it goes fast. And people try to walk through it, but it's not a thorough understanding like it really should be. Today I'm with Mason Walker. He's from Guaranteed Rate in Great Falls. He's a broker.
Yes.
You've been in the business
18 years.
18 years. He's done a lot of mortgages, a lot of lending, and is going to walk us through.
So basically we'll start with an online application or meet in person, whichever one's easiest and most convenient for the client. You know, we can send out a link through an email address that has an easy 10 to 15 minute application process. And from there, it gets directly imported into my system. I can take a look at it and I can fill in the missing information or fill in the missing links, and we kind of can go from there.
So what I have people say, oh yeah, I'm making a lot of money now. I'm great. But it's not just what you make. It's not just your income. What are you looking at to pre-qualify? And pre-qualifying means that you can pull the trigger. You can buy this property. You can afford to, and they're going to give you money.
We're looking at three basic criteria. Income to debt ratio, which is basically your income divided by the amount of debts equals a percentage rate. We're looking at credit scores, and we're looking at assets, or basically where or how much you would have for a down payment, or if you would need assistance for down payment. Lots of different options available.
So what's your guideline for debt to income? Like, can I have 4 Mercedes and a boat and a 10 side-by-sides and only make $100,000 a year?
Probably not.
Okay, so what, help these people understand, if you would, please.
We like to see debt to income ratios on the back side to be under 45%. Higher credit scores will carry a higher debt to income ratio and higher down payments.
So what's the 45%?
That's the back end ratio. That's the total amount of debts versus your income. So that
Okay.
adds your boat loans, your side-by-side loans, your car loans, and your housing payments. There's a front end ratio, which is just the housing ratio, and then there's a back end ratio, which is the total amount of debts.
So combined, you can have that.
About 45%.
Okay, that's
Yeah,
with your
40
mortgage
yes.
and your other debt.
Yeah, that's total debt.
Okay,
Yeah.
so total debt, 45%. So if you make $100,000 a year, you can have $45,000 in debt, including your mortgage
Yeah.
and everything else.
Yeah, well, it's broken down on a monthly scale.
Okay.
So your monthly income, you know, let's say $120,000 a year is $10,000 a month. So out of that $10,000 a month, you would be at, you know, $4,500 in debt to equal those
Wow.
ratios.
That's generous.
So,
you
yeah.
got to really have a budget then
Yeah.
if half is going to your debt.
And those numbers can fluctuate a little bit higher for special circumstances. If we've got excellent credit, excellent assets, those numbers we can see approvals up to 50%.
So is that dictated by FDIC, loans, government?
Basically our
or
federal
you guys?
government.
Okay,
Yeah,
so
it's an automated underwriting program that looks at the whole picture and comes up with a decision.
Okay, so it's not you.
No.
So this is not something, this is a rigid
Yes.
determinant.
Yeah.
Okay.
Built by our government.
And
yes.
then tell me about credit scores. What credit scores are you looking at?
Credit scores, you know, we can go subprime, you know, all the way down to 550 now. 550 to 580 is one requirement. 580 to 620. 620 to 680 is considered good credit, and 680 and above is considered great credit.
So to say that, okay, so the subprime, what does that mean?
You can go into a lower credit score, a lower FICO around the 550 with a good amount of assets and a 10% down payment now through FHA.
Okay, so 10% down, you can have a 550 credit score. Is that the only one that will go
Yes.
that? Is FHA?
Yeah. Conventionally, you'd have to be 600 and above.
Okay, okay, so we've got credit score, debt to income, and what's the other?
Assets.
Assets.
Yeah.
Okay, so can you,
Which liquid assets, not physical assets, but actual liquid assets, retirement accounts, bank statements, you know, money in the bank, basically.
so what about collateral loans? Do you ever do those against your assets?
They can be done. They're limited in what you can use them for as far as down payment goes and what type of loan programs.
Interesting. Okay, so that's what you're going to, so my buyer calls you, those are the things you first ask within this application.
Yes, those are the first things I look at is credit score, debt to income ratio, and assets.
So you were just telling me guaranteed rate, you can give an answer, well, not just a pre-qualification.
We are running a new program called Same Day Mortgage, which is usually approvals within 24 hours.
So there's a difference between pre-qual and
Pre-approved.
Pre-approved.
A pre-approved is a verified pre-qualification, basically, where we verified income, we verified assets, we verified employment.
That's pre-approved.
Yes.
And that are most lenders looking, who's looking at that? I guess the seller would be looking at it.
We consider it a loan program made to compete with cash offers.
Oh,
Because we
that's huge.
can basically insure with that same day mortgage, we can insure a 10-day closing, provided we have title, appraisal, and insurance returned in a timely manner.
So I always tell my buyers and sellers expect a 30 to 45.
Yeah,
And you're saying-
we as a company, we feel there's no reason why these deals should take 30 to 45 days.
Interesting. That's fascinating. So what do you think? What's going on with rates? What's your prediction?
All industry predictions is that they're going to be going down. It's yet to be determined. We have seen, we've seen spikes as high as 7.25 to 7.5, and we've seen lows in the last 3 months, around 6%. So there is a good fluctuation there. Hopefully inflation numbers will continue to come in favorable, because that does really have a favorable effect on our interest rates.
Of course. Okay, so they call you possibly within 24 hours, you have a pre-approval.
A pre-approval, yes.
That they can then take to the seller of the house and stand behind it. So then I think a big part of this, so you get pre-approved, you've got those 3 tenants covered, then they go through their inspection, go through an appraisal. Where are you, because people say, well, I want this appraiser, I don't want that appraiser. How do you handle that?
With Dodd-Frank, there's no real choice on appraisers as far as making a physical choice. We have an approved appraiser panel, and it does go through a rotation on that panel. We can dictate how many days it takes to keep within our hopefully 10-day window. We can dictate whether we want an appraisal due in 3 or 5 days, and we can either accept or decline their offer.
That's because the 10-day, a lot of times the 30 to 45 is because you're waiting for an appraiser. Yes. So when you call out for an appraiser, you don't have any control over who it is, but you can say...
We can control the due date.
The due date.
Yes, and if they counter with a longer than expected delivery date, we can accept or decline the offer.
Okay, so you pre-approve them within 24, and an underwriter's looking at this. Someone who says, these guys, we stand behind them, they're a worthy buyer, we're willing to loan to them.
Yes.
Then does it go back through underwriting when it gets after the appraisal?
Only the appraisal and title commitment.
Only the appraisal and title commitment. After that, so
everything's already been verified for 90 days. So
that's fascinating. That's interesting. So you're not a bank, you're a broker, but
yes.
You can get the same kind of loans that a bank can.
Absolutely. In fact, I think we can do more, on the non-conforming side. What non-conforming is loans that don't quite meet secondary market guidelines or can't be sold to Freddie and Fannie, such as bank statement loans, rental income loans, asset depreciation loans. We have a lot more options as a brokerage house with a lot more investors to get deals done.
So that's that's a big part of it that you're talking about, is these other kind of loans. I get so many sellers and buyers, mostly buyers, that say, okay, I bought this house and I'm not even sending my mortgage anymore to to you. I'm sending it to somebody else. Can you explain people to understand the primary and the secondary market?
So a primary market is loans usually sold to Freddie and Fannie, the two government entities that purchase a lot of these loans. We retain servicing for those loans, but those loans still can be sold on secondary markets. They can be pooled for investors and sold off to different banks that would basically control your escrow account and receive your payment.
And that's how you're making your money. That's how a lot of banks are making their money. They pull somebody in, you bank at Wells Fargo or wherever, and then you go in and talk to them. They get this loan, they charge the loan fees, and then they sell those loans.
They can pool those loans together and sell them in bulk.
So let's talk about the loan fees. So what's it going to cost me? What is the loan going to cost me besides after we close that percent, whatever the prime plus?
As far as closing costs go or origination costs?
Yeah, what are you going to charge my buyer?
It really will vary depending on, right now we're seeing a lot of discount points to buy down interest rates.
So who pays for those?
So it can be paid by either the borrower or the seller.
So negotiating, so give me an example of that.
So if it's negotiated into a buy-sell agreement where the seller agrees to pay up to 2 or 3% in buyer's closing costs, that would be paid by the seller. The buyer can themselves also contribute to their own interest rate by paying down points or buying a percent down. 1 point is 1% of the loan amount. That does not equal a 1% discount, though. It usually will equal a quarter to 3/8 of a discount.
Explain that to me.
So 1 point buys down, like say if we were locking today at 6.5% and you wanted to buy down your rate, 1 point would be 1% of your loan amount and would buy it down to 6.25. Usually the recap on that, or the recoup on that discount point is average 2.5 to 3 years.
So you have to stay in the home to get your money back from this buy down.
We are offering, guaranteed rate is pushing right now on it's called a 2-1 buy down program. So if you can get a seller to agree to pay 3% of your closing costs, we could lock your rate at 6.5 today and use that 3% in closing cost. The first year your interest rate would be 4.5, your second year would be 5.5, and the third year it would hit the 6.5% interest rate. So it's basically an interest break for the first 2 years of the loan, which on a $400,000 house, the average saving is about $700 a month.
Oh, that's
for the first
substantial.
year.
So you should definitely talk to you about that.
So
that we were seeing before the market, it's competitive again in Great Falls for sure, but asking sellers weren't paying towards closing costs. I generally say, and you're the expert, I want to hear this from you, we usually say it's about 3% for your prepaids and your loan fees.
Yes.
About 3% of the total amount. So if you're buying a $100,000 house, they're going to give you about $3,000 of that. And the prepaids, people don't understand. So the 3% isn't just goes to your pocket.
correct.
Can you explain
Prepaids
to
are
these?
basically a hard cost item. That is your taxes and insurance. Those are fees that are going to be on every loan no matter what you're doing.
So explain that.
So basically an escrow account or prepaids is collecting 12 to 14 months of homeowner's insurance and collecting a tax reserve. So when taxes are due in May and November, we have built this escrow account at closing to make sure there's enough funds to get those paid.
So even if they're paying them monthly within their loan to you, you want to make sure that the government doesn't take over their house because they've not paid their taxes.
Yes, so we have an escrow account set up to make those
And the same with
payments
insurance. If
for
the
them.
house burns down and you didn't pay
Yep.
your insurance, then you're covered.
The insurance is paid 12 months ahead of time, basically. We're collecting 12 to 14 months at closing. And then when it comes due this time next year, we'll have that escrow account from the 12 months worth of payments saved up
So-
and make that insurance payment.
$100,000 house, $3,000 the seller or the buyer can expect to pay. But it's not all for true loan fees because there are
No.
these other things built into it.
Yeah.
And we're seeing that a lot. I mean, I know me as an agent, I was not writing those as much this year, asking for the seller to
True.
pay, but that's all negotiable. And it doesn't have to be the full amount, it can be smaller amount. What are you seeing now? Are you seeing that come back
We're starting
more?
to see a comeback on that now, yeah. And we are seeing offers renegotiated after the fact. You know, if they accepted a $100,000 offer, well, what if we bumped it to $103,000 and had you pay $3,000 in closing costs?
Can you do that? Yeah.
That way the seller still nets the same exact amount, but it's a way to build in closing costs as long as the appraisals
Yeah,
come
the
in.
appraisal is the only big one on that. So most people you're seeing, is 3% a good number?
Yeah. 3% is usually the max. That, on FHA, VA, and rural development, that closing cost can actually be up to 6% that a seller can pay. But on conventional, with 5% down, 3% is the max.
So interesting. Well, it's a roller coaster ride now, and just understanding, talking to an expert and walking through them. I really am big on my buyers. I need you to understand what you're paying. Oh, I can afford this, I can afford this. Go through a worksheet, really understand, can you afford this? What do you have in cash? what do what are you going to be able to do once you get in that loan? And so I really appreciate you taking the time and explaining to people, what's out there and what are some of their options and what they can expect to see when they're getting pre-qualified.
Yeah, I truly feel like our position is a home ownership counselor as well as a lender. We're going to counsel people. I love people to come into my office where we can sit down and go face to face and put it on paper and show it to them line by line, and counsel them. Is this the best decision? Is your money best used here, or would your money best be used to put a lower down payment and maybe pay off some more debt? There's lots of different options. 20% down is not necessary on a mortgage any longer. We can do as little as 3.5% down, depending on the loan programs.
And even less if it's some of these other loans that
and
we're
rural
going to talk
development
about.
and VA, 100%.
Yeah, we're going to go talk about those. But no, this is why we're doing this, frankly, is because we feel like we're counselors too as agents, but I'm not an attorney, I'm not an accountant, I'm not a lender, I'm not an appraiser. So people more understanding it before they even walk into your office, being better prepared, I think better buyers. These are big commitments for people. Whether it's 50,000 or 500,000, those are big numbers. Usually somebody's biggest asset is their home.
Absolutely.
So really getting that seems important, and that's why Live in Montana is working with you and other people who are experts in that field.
Yeah.
So thank you very much for your time.
You're welcome.
Thank
you.